Hey, I'm Alex. I'm a CPA with Stronghold Accounting, and today I want to talk about how a client missed out on $500,000 of deductions. If you don't know me, my background is auditing publicly traded companies. Now I help small businesses optimize their profit, their cash flow, and their tax position. And I wanted to show this example because it came across on a phone call I was on with a new client. And I have this layout here just to show you, if you're not aware, the balance sheet versus the profit and loss. So your balance sheet is going to hold all of your assets, any of the debt liabilities, whereas the P&L is going to be the one you're probably most familiar with as a business owner, your income, expenses, and your profit. So when you file your tax return, the taxes you pay are based upon the net income of your profit and loss. So it would be here at the bottom, that net income piece. Now, the thing that happened with this client is that, imagine you're a business owner, you're building out a new location, right? And they were tracking the expenses of this build out on the balance sheet. So they were booking it as an asset. So it would not show up on the profit and loss. It would show up on the balance sheet. And that was to the tune of $500,000 over the course of around a year. So they had $500,000 on the balance sheet. That was for real deductible costs that they had built out this new location. What happened was there was a miscommunication between the prior accountant and the tax preparer, and that $500,000 was never deducted on the profit and loss, because what happens when you put it on the balance sheet is eventually it's depreciated over time, and then it shows up eventually over time on the P&L, and that becomes a deductible expense that impacts your net income. So this ended up never making it over for 3 years. Now it's 3 years behind. In that 500,000, just to give you an idea of the impact, if I pull out my calculator here, actually I'll do it right here. Let's say you had a 30% tax rate, just as an example. That's $150,000 in cash on cash savings that could have stayed in your business account or personal account and not went to the IRS. Tell me that's not crazy. Just figured I'd share it. In this situation, there should have been communication between the accountant and the tax preparer. It probably should have never been on the balance sheet to begin with. I would have rather expensed that location on the P&L and seen on the P&L the different locations by column, so location A, B, and C, and the cost to build out each. Unless it's a big asset purchase, that's when I would put it on the balance sheet. But these were for like small $1,000, $500 expenses, times 1,000 of them. So it should have never happened with best practices. So I just wanted to make everyone aware that the difference between a high quality accountant can be hundreds of thousands of dollars in your account. And also, because this was on the balance sheet, guess what that did? That impacted the profitability of the business. And so the business owner was looking at this, I guarantee you, and was saying, oh, great, we have a lot of profit this year. But none of this was captured. So you're not even getting an accurate picture of your financial situation. Again, my name's Alex. I'm a CPA with Stronghold Accounting. My background was auditing public companies. Now I help small businesses. If you're interested in learning more, you can book a free consultation on strongholdassociates.com/free consult. We do a financial health assessment of your QuickBooks, so we'll identify any red flags similar to this on the balance sheet, your P&L, any areas of opportunity, something that the IRS or a bank, when they look at your financials, may catch. So we'll present that to you within 24 hours and get you a custom proposal of what it looks like to work with us on a monthly basis. Again, my name's Alex. Thanks for watching.